Mutual funds are investment vehicles. They pool money from many investors. This money is used to buy a variety of assets. These assets can include stocks, bonds, and other securities. Think of a mutual fund like a basket. This basket holds many different fruits. Each fruit represents a different investment. When you invest in a mutual fund, you own a small piece of the whole basket. Mutual funds are managed by professionals. These professionals are called portfolio managers. They make decisions on what to buy and sell within the fund. By investing in a mutual fund, you are essentially hiring a professional to manage your money along with the money of other investors. One of the biggest benefits of mutual funds is diversification. Diversification means not putting all your eggs in one basket. When you invest in a mutual fund, your money is spread across many different investments. This helps to reduce your risk. For example, if one stock in the fund performs poorly, it may not significantly impact your overall investment. This is because the other stocks in the fund may be performing well. Diversification is a key principle of investing. Mutual funds make it easy to achieve diversification, even with a small amount of money. Another benefit of mutual funds is professional management. When you invest in a mutual fund, your money is managed by a team of experienced professionals. These professionals have the knowledge and resources to research and select investments. They also monitor the market and make adjustments to the fund's portfolio as needed. Professional management can be particularly beneficial for investors who don't have the time or expertise to manage their own investments. It provides peace of mind knowing that your money is in capable hands. While mutual funds offer many benefits, it's important to be aware of the risks involved. One of the main risks is market risk. Market risk refers to the possibility that the overall market may decline in value. When this happens, the value of your mutual fund investment will also decline. It's important to remember that market fluctuations are a normal part of investing. There will be ups and downs along the way. However, over the long term, the stock market has historically trended upwards. Section 5. Risks of mutual funds, fees and expenses. Another risk to consider is the fees and expenses associated with mutual funds. Mutual funds charge fees to cover their operating expenses and management fees. These fees can vary depending on the fund. It's essential to pay attention to the expense ratio, which is a measure of the fund's annual operating expenses. Higher fees can eat into your returns over time. It's generally advisable to choose mutual funds with lower expense ratios. Section 6. Types of mutual funds. Equity funds. There are many different types of mutual funds available, each with its own investment objective and risk profile. One common type is equity funds. Equity funds primarily invest in stocks. Stocks represent ownership in publicly traded companies. They offer the potential for higher returns but also come with higher risk. Within equity funds, there are subcategories such as large cap funds, which invest in large companies, and small cap funds, which invest in smaller companies. Section 7. Types of mutual funds, bond funds and money market funds. Other types of mutual funds include bond funds and money market funds. Bond funds invest in bonds, which are debt securities issued by governments and corporations. Bonds generally offer lower returns than stocks but are considered less risky. Money market funds invest in short-term debt securities and are considered very low risk. It's important to choose a type of mutual fund that aligns with your investment goals, risk tolerance, and time horizon. Section 8. Choosing the right mutual fund, research and fees. Choosing the right mutual fund can seem overwhelming, but there are some key factors to consider. First, research the fund's past performance. While past performance is not necessarily indicative of future results, it can give you an idea of how the fund has performed in different market conditions. Look at the fund's expense ratio and make sure it aligns with your budget. Consider the fund's investment objective and ensure it matches your own. Section 9. Advice for first-time investors. Starting with mutual funds. Mutual funds can be a great starting point for first-time investors. They offer a simple and convenient way to invest in a diversified portfolio of assets. Start by determining your investment goals, risk tolerance, and time horizon. Then, research different mutual funds and compare their fees, performance, and investment objectives. Consider investing a small amount initially and gradually increasing your investment over time. Remember that investing is a long-term game, and patience is key.